Welcome to HouseLux Estate, your go-to channel for all things investment and real estate. We're here to provide you with a wealth of knowledge, insights, and strategies to help you navigate the complex world of investing. Today, we're stepping into the intriguing realm of behavioral analysis and its impact on investment decisions. You see, investing isn't just about numbers and financial data. It's also about understanding human behavior, the emotions, biases, and psychological tendencies that influence our financial decisions. This is where behavioral analysis comes in. It helps to unveil the why behind our investment choices, enabling us to make more informed and rational decisions. In this digital age, the role of behavioral analysis is more crucial than ever before. It equips us with the tools needed to dissect the complex interplay of human emotions and market trends, ultimately guiding us towards more successful investment outcomes. Stay tuned as we delve into the fascinating world of behavioral analysis and its role in investment decisions. First, let's understand what we mean by behavioral analysis. This term might sound a bit intimidating, but it's quite straightforward. Behavioral analysis is all about studying and understanding the actions, reactions, and patterns of individuals or groups. It's like being a detective, but instead of solving a crime, you're unraveling the mysteries of human behavior. Now, you might be wondering, what's this got to do with investment? Well, a lot more than you might think. You see, investment isn't just about numbers and charts, it's about people. People's behavior, their decisions, and their reactions to different situations play a huge role in investment outcomes. To put it in simpler terms, behavioral analysis in investment is like trying to predict the weather. You're not just looking at the clouds, you're looking at patterns, trends, and changes over time. You're trying to forecast what's going to happen based on what has happened before. And just like weather forecasting, it's not always 100% accurate, but it can give you a pretty good idea of what to expect. Behavioral analysis is widely used in various fields, from psychology to marketing, and yes, even investment. For instance, in marketing, companies use behavioral analysis to understand consumer behavior and tailor their strategies accordingly. In psychology, it's used to understand human behavior and develop effective treatments. In the world of investment, behavioral analysis helps investors make more informed decisions. By understanding the behavioral patterns and tendencies of other investors, they can anticipate market trends and make strategic moves. For instance, if a majority of investors are behaving in a certain way, it could indicate a potential market shift. Behavioral analysis is not just about observing others, though. It's also about understanding one's own behavior. By being aware of our own biases and tendencies, we can make better investment decisions and avoid common pitfalls. With a clear understanding of behavioral analysis, let's see how it influences investment decisions. From understanding market trends to making strategic moves, behavioral analysis is a crucial tool in the investor's toolkit. It might not guarantee success, but it certainly increases the odds. So let's dive deeper and see this tool in action. Remember the dot-com bubble of the late 90s? The tale of this bubble is a classic example of how investor behavior, fueled by hype and the fear of missing out, can inflate a market bubble that inevitably bursts, leading to catastrophic financial losses. Let's paint a picture of the late 90s. The internet was a new frontier, an uncharted territory that promised unimagined wealth. As a result, investors were throwing money at any company with a quote.com quote in its name, regardless of whether it had a viable business model or even a product. The buzzword was potential, and the hype was real. Investors, both institutional and individual, were driven by a fear of missing out on the next big thing. This created a classic case of irrational exuberance, a term coined by then Federal Reserve Chair Alan Greenspan to describe the unchecked enthusiasm that drives asset prices up far beyond their intrinsic value. This exuberance was further fueled by the herd mentality, with investors following the crowd without stopping to analyze the fundamentals of the companies they were investing in. The result was a bubble that kept growing until it couldn't sustain itself any longer. When the bubble burst between 2000 and 2002, many of these dot-com companies went bankrupt, wiping out billions of dollars in investment. The Nasdaq Composite, a stock market index heavily weighted towards technology companies, lost a staggering 78% of its value from its peak in March 2000 to its trough in October 2002. In retrospect, it's clear that behavioral factors played a significant role in the dot-com bubble. Investors were lured by the allure of quick riches and the fear of missing out, while ignoring the fundamentals of the companies they were investing in. This case study illustrates how understanding investor behavior could have helped avoid massive financial losses. By recognizing the signs of irrational exuberance and herd mentality, investors could have made more informed decisions, potentially saving themselves from the financial devastation that followed the bursting of the dot-com bubble. Another example of behavioral influence on investment decisions is the 2008 housing market crash. The backdrop of this tale is a booming real estate market, where houses seem to only increase in value. Investors, both individual and institutional, were swept up in a wave of irrational exuberance. They believed that the housing market was invincible, a belief that was bolstered by easy credit and loose lending standards. This overconfidence led to risky investment decisions. People who couldn't afford homes were given mortgages, often with little to no down payment. These subprime mortgages were then bundled into complex financial products and sold to investors who were hungry for high returns. The assumption was that even if a few homeowners defaulted, the overall housing market would remain strong and the investments would still be profitable. But as we now know, this was a classic case of groupthink and confirmation bias. Everyone was so convinced that the housing market could only go up, they ignored the warning signs. When homeowners began to default on their mortgages en masse, the house of cards came tumbling down. The resulting crash wiped out trillions of dollars in wealth and led to the worst economic crisis since the Great Depression. The 2008 housing market crash is a stark reminder of what can happen when investors let their emotions and biases guide their decisions. They became overconfident, ignored the risks, and followed the herd right off a cliff. If they had taken a step back and analyzed their behavior, they might have seen the bubble for what it was. So, what can we learn from this? First and foremost, that it's crucial to keep our emotions in check when making investment decisions. We need to be aware of our biases and not let them cloud our judgment. And we should always remember that if something seems too good to be true, it probably is. This case study underscores the importance of behavioral analysis in predicting and mitigating investment risks. So, how can we use behavioral analysis in making investment decisions? Well, understanding investor behavior is crucial in making informed and effective investment decisions. Behavioral analysis allows us to dig deeper into the psychology of investors, providing valuable insights that can help navigate the volatile world of investing. Let's talk about some strategies for applying behavioral analysis in the investment realm. Firstly, avoid the herd mentality. It's easy to follow the crowd, especially when the markets are booming and everyone seems to be making money. But remember, what goes up must come down. The dot-com bubble and the housing market crash are perfect examples of this. Investors who followed the herd during these times found themselves in financial trouble when the markets crashed. So it's essential to make independent decisions based on careful analysis rather than following the crowd. Secondly, be aware of your biases. We all have them, and they can significantly affect our investment decisions. For instance, confirmation bias can lead us to seek out information that confirms our existing beliefs, while ignoring data that contradicts them. Overcoming these biases involves being self-aware and questioning our assumptions regularly. Lastly, make decisions based on data rather than emotions. Investing can be an emotional roller coaster, with the highs of a booming market and the lows of a market crash. But making decisions based on emotions can lead to impulsive and often regrettable choices. Instead, rely on data and thorough analysis. This approach can help you stay grounded and make rational decisions, even in the most turbulent times. In conclusion, behavioral analysis plays a pivotal role in investment decisions. By understanding not only market trends, but also our behavior and that of others, we equip ourselves with the tools necessary to navigate the investment landscape successfully. By understanding our own behavior and that of others, we can make smarter investment decisions. In conclusion, behavioral analysis plays a crucial role in investment decisions. It provides a lens through which we can view and interpret market trends, helping us predict how investors might react in different scenarios. We explored this through two case studies, the dot-com bubble and the housing market crash. Both instances highlighted how investor behavior, fueled by cognitive biases and herd mentality, can lead to market bubbles and crashes. Behavioral analysis, therefore, is not just a tool for understanding these phenomena, but also a means to make more informed and prudent investment decisions. It enables us to look beyond the numbers, to understand the human factors that drive market movements, and to anticipate potential pitfalls and opportunities. By integrating behavioral analysis into your investment strategy, you're not just following the market, but understanding it, and that can be a game changer. Remember, by understanding and analyzing behavior, you can become a more successful investor. Thanks for watching House Lux Estate. Don't forget to subscribe for more insightful videos on investment and real estate.